Oh, all right. So, Pam, tell
All
us about
right. Well,
yourself.
we will go. Well, thank you guys so much for having me. As Kristen mentioned, my name is Pam Vroman. I'm a loan officer and branch manager of direct mortgage loans. I have been in the industry for 24 years now. I live, eat, sleep, and breathe mortgage banking and truly love our industry. I think the thing that you'll find when getting into real estate is that your lender and title partners are really advocates for you. You're oftentimes will talk to us more than you may talk to your spouse some weeks. So having a good one at your fingertips that's experienced, that knows the local programs and markets is key. As you're starting off your career, also we want to help educate you. We also want to, keep you on the up about new programs. I think as mortgage loans and different programs we have available to us as marketing. So we'll dive into that a bit and how we can support your business because, again, we are really a partner to hopefully help you gain more business. All right, so we'll go ahead and kick it off. This kind of gives you, to start off, a timeline of the home buying process from application to closing. So very often you're going to have those purposeful conversations where somehow you're sliding in, bringing in real estate, and someone says, "Oh, I'm thinking about buying." Awesome. Well, where are you looking to purchase? How soon? Awesome. Do you mind if I connect you with my lender? Having that conversation and that pass off to a lender that like, and trust is important. And also kind of understanding what we're going to do on that call. It's not an intimidating conversation that we have with them at first. Typically, we're going to try to keep them motivated, engaged on the prize, which is home ownership, right? So you guys have a bit of the funner part of the process, which is viewing and showing homes. Some of the mortgage piece, full transparency, can be a bit daunting. But on that first call, we're going to keep it light. It's about a 10 to 15-minute call where we're just going to gather information and try to determine kind of what they're looking to spend, what property type, what area, and how soon they're looking to buy. So once we've gathered their employment, income, and asset on what we consider an application or that kind of intake, we will then circle back with them, sort of congratulating them. Good news, we have you qualified. We're now going to request a set of income documents to finalize your approval. If they're a salaried borrower, our process is that we'll give them an amount that we can qualify them for, and we'll start to dive into the program. However, you're going to see that some borrowers' income you cannot determine until we obtain their income documents. So, for example, if they're self-employed, we won't know an idea of what they qualify for without having their tax returns. It's virtually impossible. So we request a set of income documents, which is really going to be a bit of homework for them. So again, because you're our partner, you're going to want to make sure your follow-up is in line with ours. So while we're asking for the income docs, a good agent is also helping encouraging them to get those docs into us. Again, it is really work for them to get these items, so it's not as exciting as it is looking at the house. So you want to help us get them in. Ultimately, it's our job, though, to chase them down. Once we've gathered those income documents, we're going to be able to finalize their pre-approval and start to dive into numbers with them. So we're going to give them their ceiling of what they qualify for, and then we're also going to hone in on their personal budget. So, for example, they may qualify for $500,000, but they've identified that they're going to be purchasing beneath their means at $350,000. Therefore, we're going to focus on that $350,000 price range so they know exactly what the monthly payment would be and what to expect from a cash to close number. They qualify for down payment assistance programs and grants. We will also go over those programs at that time so they know exactly what to expect and to start taking any classes that they may need to place an offer. One thing that you're going to notice as clients are looking on the internet is that Zillow, Trulia, Realtor.com, all these websites are going to list a mortgage payment that is typically with 20% down. Most homeowners and first-time buyers are not putting down 20%. So making sure they know their numbers before you take them out to a house is really going to help save you time so that you're not taking them to look at $500,000 homes when really their budget is like $275,000. So that pre-approval helps kind of weed people and point them in the right direction.
Pamela, I was gonna say, appreciate you mentioning that, like all those things giving those like 20% down. I've even seen some that only show principal and interest and not also
Yeah,
like the property taxes. And it makes a huge
yeah.
difference to have like a clear understanding.
It really does. And unfortunately, it then causes me to have to be the bearer of bad news. It's like your $500,000 mortgage is probably going to be more than what they expected. But again, we want them to be looking at the right properties in line with their budget so that you as an agent are not, wasting your time. The one thing I will say in our industry is that making sure that you're working with the right buyers, that they're looking in the right price point is important so that you're again not wasting your time, energy, or gas money. Caroline, you had a question? Oh, I think she's on mute. Are you able to unmute her, Kristen, or does she have to do that herself? It looks like she's
Sorry,
trying to
I'm on my
unmute.
phone.
There you go.
Sorry, I'm on my phone. So I'm
All
like,
good.
what am I having here? I'll do it on my computer, but now I'm like searching. But my question was like, for example, if you say, okay, listen, I'm going to hook you up with my lender. I think it's also
Hmm.
like important to say, like, listen, this is non like binding in that sense, because sometimes
Yes,
I think clients can get a little scared, right? Like they're like, oh God, I'm going to see someone
that's right.
and then now I'm going to be locked in or what
Yes,
have you. I think it's a
that
good
is
way
correct.
for you to be like, hey, listen, this is a non-binding, like a quick conversation just to give you a range and a quick understanding of what you may or may not qualify for and give you a better range. Because I think it's a little daunting when you think you have to see someone and talk to them about money. People, that's a little bit like, oh, you know.
I'm so glad you mentioned that. That's great. One thing that I would add to your point there. I love that you said it is non-committal. Like you're just getting yourself started. We as lenders can perform soft pulls, which would have no impact on their credit. So really, you're just having a conversation with someone, whether you buy 2 years from now, 2 months from now, or never. Getting started is really the best first step. And whether you use the loan officer you speak to originally or you don't, at least, putting them in contact with someone that, again, like, and trust is going to take good care of them, even if they don't buy. Having the conversation is really the number one way to kind of get their feet wet. And we do really try to keep it, where it's not overwhelming and motivating, but they aren't, to your point, they're really not obligated. We do have some clients who they will buy right away. And then we have some that we're nurturing for years. And real estate is the long game and follow up is key. But mentioning the soft pull for credit, I think does take a bit of the pressure off of buyers, that there's no downside of having the conversation, right? So,
Fair.
uh,
And just a quick
good
question,
point.
like for example, if I was like, oh, listen, call my friend Pam, she's a lender, what have you. Do you have that relationship where I would phone you and be like, hey, listen, I have someone phoning you. They're a little skittish, you know what I mean? Like
Yes,
give you a little heads up of where they are so that
yes,
they don't get that whole like, oh
yes.
God, you come in hard and they're like, no, thank you.
Definitely. We love all of the notes that we can have. Um, so we know how to approach them. We really try to meet the client where they are. For example, we have someone who wanted to come into the office. We had another client who speaks Spanish. We have another person, who is um, handicapped. We have someone who's deaf and needs a translator. So, I mean, wherever they are and all the notes you can give us, the better. And we do tend to, come in with a soft approach of like, you know, keeping it light.
Great.
Yeah. Awesome. Great questions. So once they have gathered their income documents, we've gone over the numbers for pre-approval. They should have a rough idea of their price range, which I'll provide to you. We'll also give them their golden ticket, which is their pre-approval letter, so they can go home shopping. So we'll celebrate all the milestones, again, trying to keep this as light and motivating as possible. And once you go to look at properties with your buyer, typically speaking, what I recommend is for you to circle back with us once you've found a home so that we can run numbers. So when we started off, we've ran numbers at, let's say, that 350 price point that may be what your buyer's looking at. Well, let's say that they actually now found a home that's a condo and there's a $450 condo fee. A, we want to look into the property so we know that it meets their financing. And B, we want to make sure we give them the numbers based on that property. And now that condo fee, we want to make sure they've taken that into consideration. Again, in the thought process of not wasting time, energy, or money, we don't want them to get under contract and find out the numbers a week later are different than what they were expecting. So we'll give them their numbers, and then you would prepare their offer. Within your offer, of course, you're going to have price point. You may be requesting seller help. You're going to talk to the lender about what the closing date is estimated to be, so that we're in alignment with the program that they're using. So for example, if they're using a state of Maryland's assistance or a grant program, we may need a little more time than, say, your cookie cutter conventional buyer who we could close in 2 weeks. So again, that partnership and communicating when you're placing that offer, maybe saying, is there anything else I should know from the lender when placing this offer so that you're in alignment? Caroline, you had another question? I think you're muted again.
Sorry, I'm trying
There you
to,
go.
I have to navigate through my phone. So quick question, and I don't even know if it's relevant, but how, or if any, important is there between like you and the title company, if any? Like, is there a, like, does it matter? Should you have a relationship with the title company? Is it relevant, not relevant at all, or?
That I have a relationship with the title company that's
Correct. I mean,
chosen?
like, does it matter, like, that everyone is on the same page, or is it like you guys are so different from that it's not even an issue?
So honestly, we can work with any title company that's out there. Going in with the offer, we don't necessarily need to have that relationship. To be honest, we've worked with probably every title company under the sun. So there shouldn't really be too much that we would need to hash out at the beginning of going in with the offer. Once we're under contract, we will work in alignment with them to get to settlement. So for example, if there are solar panels, we're going to help them get the lease from those transferred. If there's ground rent, so we will work together. But upfront, I wouldn't say that you need to necessarily get the title company involved. And 99% of the time, all title companies in the industry align with us quite well, and we're able to work with anyone for the most part. So, good question. Okay, so you are now you now have a legally binding ratified contract. Woohoo! You're going to typically perform your home inspection if the buyer has chosen one, making sure the client understands the home inspection is to tell them the working functionality of the property, your HVAC, your plumbing, etc. Once you've passed that phase and the seller and buyer have agreed on repairs or no repairs and we're moving past it, we as the lender will typically order the appraisal. The appraisal is to confirm the value of the property based on 3 to 5 other comparable sales. That is going to be different than the inspection because they're not really going to tell, diving into the HVAC and plumbing. However, there is an aspect of each appraisal that determines that the property meets the health and safety guidelines for that particular loan. So once we've obtained the appraisal, if it were to underappraise, you would go back to the negotiating table with the seller. So you and the seller would work through the appraisal, and we would have strategic ways to apply pressure to that seller, hopefully to get them to come down if it did underappraise. And that's something that we could hash out together if that happens. Most of the time, once you get past the appraisal, and if it does come in low, we're usually able to maneuver through that. It's quite rare that deals fall through for a low appraisal. I can't even remember the last time I had one that fell through. Another thing I would say, local lenders are going to have local appraisers. So sometimes you can see problems with bigger banks because they may pull a Northern Virginia appraiser to appraise Baltimore City. But for the most part, this is something that we move past. So once we have our appraisal, we are going to then begin to update the borrower's profile for underwriting. And what this means is we've obtained pay stubs, W-2s, tax returns, et cetera, when we pre-approved them. But let's say now 2 months have gone by and they're placing an offer. We're now going to need to update their pay stubs, bank statements. All of those items are date sensitive. So you as agents may often hear, oh, the lender's asking me for the same thing I already sent them. Well, we're really not usually asking them for the same thing. We're asking them for updated items. So the most recent pay stub, the most recent bank statement. The other thing to kind of keep in mind while we're working on their loan is that the loan is not completed until the day before settlement. So we're going to monitor their credit, their income, and assets all the way through closing. So if they're going to change jobs, spend a good amount of their savings, co-sign for a car, we really want them to talk it through with us first to make sure it's not going to affect their settlement. In December, I had a client who pulled some money from their 401k, which we thought was for settlement, but they actually ended up taking it and using it for a cruise. It did cause some rifts in their closing. We got them to settlement, but having that open communication and telling us the good, the bad, the ugly is really what's best, because that way we can walk them through how to navigate those items.
Pam, my
So once
daughter,
you go into,
I was going to say my daughter, when she bought a house, the house she got had somebody else was under contract and it fell through the day before settlement. The sellers had all their belongings in a moving truck already and it fell through. And like, so, and
oh
I've
my
seen
gosh,
it. I know it's not terrible, but yeah, it does happen.
yeah,
And it just that client just, I think in her case, they just stopped. They thought they were pre-approved and stopped paying their bills. And then, you know, yeah.
yeah. And we remind them of this throughout the
Yeah.
process. When they're pre-approved, we're going to tell them, like, tell us everything. Tell us if you're going to change something. Like, approvals are based on every aspect of your profile, your credit, your income, your savings. So for example, if you had $20,000 when we pre-approved you, and now you're only going to have 4,000, you may not qualify. Similar to if your credit score drops significantly, it could change your qualification. So we really don't want to rock the boat. And if they are going to do something, just talk to us, because some buyers, to be honest, they can go buy furniture, they can go use their savings because their qualification is, really solid. But then you have other buyers where it's like, do not sneeze, because it could rock the boat. And then we tell them after settlement, do whatever you want. Once you're closed, you're good. It's just staying intact, and not having anything change while we're in underwriting. So underwriting for us is local. We have an underwriter that works directly for my team. And what that means for you as an agent is that if we run into a hurdle, I'm going to be able to pick up the phone and speak directly to the person who signs off on these hurdles to work through them very quickly. So my friend who went on the cruise a week before settlement, we were able to maneuver through that problem with ease. We're not a call center. We're small, we're nimble, and having the underwriters that work for us just makes the process really smooth, which then if it makes it smooth for the buyer, hopefully we get more referrals as a team. So now you'll have your underwriting approval. The underwriter will come back asking for what we call conditions or stipulations to close. It could be items such as the homeowner's insurance to be finalized. Maybe we need something clarified with title. Let's say they have solar panels, we need them transferred. Maybe a correction from the appraiser. So these minor, minute things, the appraiser or the underwriter is trained to work through the file with a fine-tooth comb to make sure it gets perfected. Once we've provided all those items, we are then going to issue what's called a clear to close. You'll end up loving this terminology because it means we as a lender are finally out of the buyer's hair and yours, and you can schedule your loan for closing. Typically, this is days before settlement, but you may have some where we're waiting on a grant and it could be hours. So the process moves very fast, and that's something you'll want to make your buyer aware of. That when the lender asks for something, try to get it to them within a 24-hour time frame so that we meet that closing goal on time. So Maryland is a wet funding state. They would wire the funds typically the day of or the day prior to settlement. They would complete the transaction and closing with the title company's office and be handed the keys right away. The way a mortgage starts off is, let's say they settle today in February. Their first mortgage payment would not be due until April 1st. So you're always going to skip the months that follow settlement, which can help them with budgeting if they need to break a lease, things like that. It's good to know that you're actually going to have a little leeway as far as when the mortgage starts off. All right, so credit. So one thing that you're going to see is a big part of the buyer's profile is credit. And what makes up credit is good to have an understanding of as an agent. However, I'm not going to focus too much time on this. But the number one thing you're going to see that strains credit is usually credit card utilization. So maxed out credit cards, even if they're paid on time, are going to drag down scores. So let's say the credit card limit is $1,000, the credit card balance may be $900, and that's pulling down their scores even if they pay it on time. So oftentimes we can help improve credit by paying scores down. Late payments, derogatories are very hard to get removed, so we really want them to avoid those as much as possible. If we can have them hop on a credit card as an authorized user, that will help them get credit age and credit history. So this is a bit of a loophole of the industry. And the thing that I would share with credit is that you can find there can be a lot of creativity to help boost scores. So if someone says, I don't want to talk to a loan officer, my credit scores are too low, it's like, let me talk to my girl. She's going to have some pointed ways to help boost your score as quickly as possible. And the thing with credit is that we're not, as consumers, educated a great deal here. And so talking with a loan officer is going to be the best way to get their score up as quickly as possible. And then oftentimes, a lot of people's scores are not as bad as they think. So even if they think their scores are bad, have them connect with us. Let's get them started and get them on the right trajectory to buy. Alrighty. Types of mortgage companies. So I'll touch on this just a bit. So federal depository institutions, so big banks such as Bank of America, Wells Fargo, these guys are great at certain things. However, you're going to see that they're a little less hands-on than, say, a local lender. Therefore, a lot of agents will shy away from having their clients do business there. Sellers agents are going to be looking at who your client is working with as a lender. A lot of times I know the listing agent. The listing agent's goal is to make the transaction as smooth as possible, and the lender is a big part of that. They really are going to look at that lender with scrutiny because that's going to make them get more referrals, make the process go smoother. So who your client's working with will give them a competitive edge if they're competing.
Can I just say yes to that? Like, I just want to agree with Pam on that. As a buyer's agent, when I have a buyer, I'm often like, if I'm submitting an offer, they sometimes want to know who the lender is. Is it a local lender and who is it? If in a competitive situation, you actually could even lose an offer if you have a large bank and the other agent is working with a local lender. That's how much real estate agents really prefer a local lender because the process is so much smoother. I've had a number of times my buyers already like gotten things straightened out with their large bank, whatever one it is. I'm not going to say a particular one, but I'm thinking of one. But it just takes so much longer. You can't reach somebody on the weekend. I need an updated pre-approval letter. I can't get one. It's much harder. And the listing agent knows that and knows that if they have a local lender, it's going to be smoother on their end. So it absolutely makes a difference. Caroline, what were you?
Yeah. If you know how it is to call a credit card company to ask a question, imagine getting a mortgage that needs to settle at 2:00 today with a company like that. It's like these call center mortgages lenders are just tougher to work with.
Yeah.
I've had listing agents say, hey, come up $5,000 on your offer and we can get a deal because they want to work with us because it's going to make their life easier, their sellers' lives easier. So, yeah. Caroline, you had a question?
Yeah, it seems to always be me. Sorry. No, when you say
Oh, you're
local
good.
lender, would you still consider yourself a local lender? Say, you're in Baltimore and the client's in DC. Are you still considered a local lender because you're not the big bank type thing?
Yeah, definitely.
Yes. Yep. I would say we're local to Maryland, DC, Virginia, West Virginia, Pennsylvania, and Delaware because that's like our whole region. And then even in states that we do business outside of, like, say, for example, Florida, we have a local office there.
Got it.
Now, when they say like big bank, that's going to be, say, for example, like a Bank of America, where they just have branches all over. You don't necessarily even know your loan officer could be in Florida or Texas with those guys, where with us, you're going to be within that same region working with someone there. Another aspect of it is we know the local footprint of taxes. For example, we have ground rent in Baltimore. if you work with a big box lender, no matter who it is, ground rent will trip them up because they're not as familiar with that, where we see it all the time because we focus on business here. Also, we're going to focus on the grant and down payment assistance programs that are local to Maryland. So we work with the Maryland State Program, Baltimore City, HCAP in DC, Frederick, all those county government programs. We're going to go after because we're here. The bigger box lenders are not going to work with those, typically speaking. Yeah, so just to kind of take a little deeper dive, direct lenders mean that we underwrite the loan. So our underwriter works directly for us. We're not shipping it to another company where we have a lack of control. Brokers are typically shipping it to an outside company for them to underwrite it. Our company has the ability to broker. We probably do that 1% of the time for a very rare situation that needs a unique lender. So you will see sometimes it could be an option, but we try to avoid it so that we have control over the underwriting process particularly. And then portfolio lenders. So I work with a lot of other lenders that I network with. So there's, I have nothing against other lenders that work in different entities. I think we all have our strengths in different capacities. Portfolio lenders, let's say, for example, like a Rosedale Federal, they may be able to help with a particular property, let's say owned by a business or something quirky, or a condo that no one else can get approved. So, I have friends at other lenders where if we can't do it, which is quite rare, sometimes these other entities can, and a portfolio lender would be that style of lending that in rare circumstances could help out. All right, so not going to touch on this one too much, but owning versus servicing. So when we close a loan, we don't collect mortgage payments after it settles. So there'll be another entity that they're actually writing their check to. That process is typically very smooth. None of the terms or conditions can change. However, just we won't be the one collecting the check is how that works. So I think I did touch on this a little bit with pre-approval. So again, the makeup of a pre-approval is based on employment, income, and income, savings, and credit. So for example, we could have someone approved today. If their credit score drops or their savings drop, that can change their pre-approval. Everyone's loan profile is particular to their situation, really just depending on everything that they have going on. Their loans are not a one-size-fits-all. It really kind of depends about their income, how they're paid, their debt ratio. All of those things go into factor to approving them for a loan. Mortgage insurance is good to kind of have an understanding of. And I'm going to kind of touch on this when I go into the deeper dive with loans. So we'll kind of skip through this one just so that I stay mindful of our time here. So this comparison of key loans, this is where I'll dive into mortgage insurance. So just want to mainly touch on what the benefits and downsides are of each loan product. So conventional loans are typically going to be for borrowers with A+ credit. Therefore, these type of borrowers are going to be looked at from a seller's perspective as most attractive in comparison to the 3 other loan types shown here. That seller is going to know you had to have very good credit to qualify for a conventional loan. From your buyer's perspective, if you have certain qualifications, they can put down 3%, and typically conventional, if you have good credit scores, will allow them to get the lowest payment and interest rates available. On the flip side, FHA does have its own benefits. It allows lower credit scores. So if the seller sees an FHA offer and a conventional offer, they may think that necessarily the FHA borrower has lower scores. That is not always the circumstance. It could be that our borrower needs to have all of their closing costs covered because they're cash strapped. So it kind of depends there. And that's something that we as the lender would probably dive into, like, hey, our buyer actually could qualify for conventional, but we want to get full seller help. It's more of a need for them, so that's why we're going this route. So you may see buyers at times that qualify for both FHA and conventional. FHA will also be a little more competitive and aggressive as far as approval and buying power. So for example, you may hear the lender say, okay, they can go to 350 with conventional and they could go to 380 with FHA. So they allow them to go to a little higher of a purchase price oftentimes with FHA financing. Again, FHA financing will allow the seller to cover all closing costs, where typically with conventional, they'll only allow the seller to cover 3%. So if your buyer's cash strapped, FHA could be a better option. A benefit with conventional financing is that once they've reached 20% equity, the mortgage insurance would fall off. So long-term savings is typically more applicable with conventional financing. You do not need to memorize loan programs at this point. Just kind of having a rough overview of what they are, getting your feet wet is what I'd recommend. You also don't need to memorize mortgage guidelines. We don't want you to be mortgage experts. You just need to have a good loan partner to lean on. The next loan type is going to be VA financing, which is for military veterans or their spouses. This allows for 100% financing, and it does allow the seller to cover all your closing costs. Therefore, these are great loans for our military veterans. You can see that oftentimes the appraisals are scrutinized a little more heavily, meaning that the appraisers tend to flag things more than they would for FHA or conventional. Therefore, sometimes if you're competing with multiple offers, the listing agent may choose a conventional offer over your veterans offer. So this is part of the industry that's sad but true. I wish it weren't this way, and I wish those appraisers would change their tune. They don't let me control that, but just a part to be mindful of. USDA financing is going to be for rural or more remote areas such as Carroll County, Cecil County. You have to plug the property into a map to determine if it's eligible for USDA financing. This financing type also has some quirky guidelines, such as they have an income restriction. Your income can't be too high. They also have an asset test. So these are a little less common in our area, I would share. All right. Sensitivity to credit scores, I touched on this a bit. Government loans, so FHA, VA, and USDA will all allow for lower credit scores, and we do go down to a 580 and sometimes even a little more aggressive with government loans. Conventional loans are going to be a little more sensitive to credit score. So, for example, if you have a 640 credit score, what you're going to see is that it's just tougher to get approved with conventional financing, and listing agents and sellers will know that. All right, loan limits. So the conventional loan limits each year will change. They just came out for 2026. So I think it's now like 823,000 is the conventional loan limit. Don't quote me on that. Maybe it's 822,700. I may be rounding up a bit. But that basically just helps determine how much they would need to put down. Not something that you probably need to focus on, I'd say. Let's get past this. Multi-unit properties are, a significant part of the marketplace. And knowing the different down payments is something that the lender would mainly hone in on for you. If you hear the terminology DSCR, these are typically for investment properties where the lenders are basing what the borrower will qualify for off of how much the property will rent for. So it's an investment property loan is the gist of it. Condos. If you are going to list a condo, I recommend connecting with a lender to say, hey, lender partner, can you take a look at this condo and see if you think I'm going to have any red flags when selling it to a conventional, FHA, or VA buyer? Conventionals have gotten more complicated in the last few years, and we as lenders can really do a lot of digging for you before you list that condo so you know who you can sell it to. The last thing you want to do is get under contract and 3 weeks later you find out that you actually can't settle with the type of financing that the buyer was utilizing. So getting us to kind of take a peek at these for you is definitely something I recommend. And that's where a local lender, I think we're a great partner because we're really hands-on when it comes to these condos and helping navigate how complex they can be. Second mortgages, this is something that you may see. Let's say you have a homeowner that has a $200,000 loan balance and their house is worth $400,000. This is actually really common in the marketplace now. People have a very low interest rate on their first mortgage, and maybe they're interested in investing in real estate. They can use a second mortgage to pull money out of their home's equity to invest in purchasing another home, maybe renovating their property. So that's definitely something that you could keep in mind as a marketing strategy to encourage people, to take advantage of their equity. Down payment and closing help. So we touched on a bit about down payment assistance programs. The definition of a down payment assistance program is that the funds get paid back. So the most popular program we utilize is the Maryland State Assistance Program. It gives between 5 and 6% towards their down payment and closing costs. So my client settling today, he's actually getting back his entire deposit. He didn't put any money into the transaction other than his home inspection. So these programs are great. However, the way that they work is that in 5 or 10, 20 years from now, when they go to sell or refinance the home, they're going to give the money back to the state of Maryland. So think of the state of Maryland as their rich uncle. They gave them $20,000 to buy a house. They didn't charge any interest on the $20,000, and that the rich uncle wants the money back when they sell the home. It's a great way to get into the house, and these are great things to market to. If you put out there, that you work with the state of Maryland's assistance program, buyers are going to want to talk to you about that free money. And I'm still surprised at how many people think you need to have 20% to put down when we're so far away from that. Grants, I think we touched on the FHLB grant should be getting federal funding soon. Baltimore City has funding. DC has so much money, it's insane. That these are, again, great programs to promote. If you were interested in flyers for any of the down payment assistance or grants, I'm more than happy to create those for you. I'll put my email and cell phone number in the chat at the end of the class, and you could send me an email with your headshot, and we can create a bunch of flyers for you to use and have at your fingertips whenever you'd like.
So let me just expand on that a little bit. I love that idea of having that flyer because then you could bring it with you to an open house. If you're at an open house and having trouble getting a conversation going with people who are attending, like sometimes they're trying to get out the door, you could just say, hey, have you heard about, either FHLB, or have you heard about, this whatever program the flyer's about? And then maybe this is a way that you can have a further conversation with them. Pam's not going to see the chat later, so if you want this, we're going to have her email in the chat, and I will also, if you're watching the recording later, I'm going to put her contact info in the comments there, but just reach out to her directly via email if that's something you'd like. Thanks.
Awesome.
Quick question.
So
Sorry.
just to kind of, oh, you're good. Go ahead.
No, just with the assistance and the payback, I didn't hear. Is that interest free or how does that work? Do you know?
Yeah. So the way that it works is they give you 5% of your loan amount. Let's say on a $200,000 loan, they gave you $10,000. That you don't pay interest on the $10,000. So it's considered a silent second mortgage.
Got
You
it.
pay no payment or interest on it. However, the loan itself may have a higher interest rate depending on the program that you use. So, and depending where your credit scores are. I mean, the state of Maryland's interest rates right now are neck and neck with other rates. So if you have a 640 credit score, they're giving you just as good of an interest rate as you probably would have gotten anyways. So it just depends, but they don't charge interest on the actual money they give you towards the down payment and closing costs. So to kind of give you an example on like how my buyer today sort of is coming to the table with no money is, let's say he purchased with a conventional loan that requires 3% down. Closing cost estimates are typically about 4.5% to 5%. It depends on the county, the taxes, how your compensation is being paid. A lot of factors will go into this number, but let's say we're using 5% as a roundabout number. That's a total of 8% in costs. We're getting 5%, we're going to minus off from that from the state of Maryland. So now we've got 3% left in costs. It technically is the buyer's portion of the closing costs that they're responsible for. However, we could get what's called seller credits or a seller concession to cover that remaining cost. And that's exactly what happened with our seller and our buyer that's settling today. So therefore, he's getting all of his costs covered. He even got back his deposit at settlement. Good thing about the market today that you can share as a selling point is the market has shifted and we're seeing more seller help than ever. During COVID, buyers that were cash strapped really had a tough time in purchasing. So there's a lot of buyers in the last few years that have wanted to buy that have not been able to. And this market has opened up a lot of opportunities for those buyers. All right, so next, investor cash flow loan. That's going to be the DSCR program where you're basically calculating what they're able to purchase off of how much the property would rent. So these are a big part of the marketplace and another thing for you to market to. Speaking of marketing, I recently had an agent who I've been working with for a while, but she suddenly is sending, gosh, probably a lead a day over. And I was like, Yvonne, what do you have going on? And she's like, it's all TikTok. I'm like, oh my gosh, let me see what you're doing. And, she's just posting short clips every day about things that buyers really want to know. She's keeping it really simple. She's touching on, grants and down payment assistance. She's giving them short information about misnomers and things of that nature, and really just crushing it. I would say the number one thing is that she's doing it consistently, and she's kept it really simple, keeping it in layman's terms so that that average first-time buyer is able to kind of connect and understand. So I think that any of these mortgage programs that you've heard about, if you have more questions or anything that I can help with along those lines to help you market them, I think there's a huge opportunity, especially with social media, and it's free. So
We like free.
Right.
I put your contact questions in the chat.
Oh, thank you.
Yep.
Yeah, and we could definitely send over the, if you happen to have a list of the attendees, I could send the PDF over, or I could just send it to you, Kristen, whichever is easier, just for you. Okay.
And I'll distribute it. Yep, cool.
Okay. Set up my list.
Awesome.
I do have one question about that Maryland Rich Uncle program. I'm going to call it. So,
I like that.
What if they never sell the home? Do they owe Maryland the money?
So eventually, at some point, their heirs would then inherit the home. At some point, I guess, if it doesn't get technically sold, I'm trying to think if when the heirs inherit it, if when it transfers title to the heirs, I would think they could keep the mortgage and keep.
Pam, we lost your audio.
Yep. Can you hear me?
Yeah.
Okay. My thought process there was that if the heirs take over, let's say their children get the home and they just keep paying that mortgage, then I don't think it would have to be paid back. Now, if the heirs refinance at some point, then it would get paid back. So.
Okay, thank you so much. That clears a lot up.
You're welcome.
All right. Well, thank you so much for joining us today. I really appreciate it. And you guys definitely reach out to her and take her up on these flyers. It is such a great marketing tool, just a great conversation starter. Even just if you have them to text somebody, like just to be able to get somebody's cell phone number, super, super, super handy.
Yeah, thank you. It was super helpful.
Yeah, I often feel like I run out of ideas and content to post on social, and then I teach a class and I'm like, oh my God, there's so many things. Just look at the class slides and be like, DSCR loans, down payment assistance, grants, like, do you know, like all that stuff's in there. Just stay consistent. Another bit of advice that I would say as a new agent is that, it takes a little bit to get your confidence. I would say get confident in saying, let me do some research and get right back to you. 20 years from now, you're still going to say that same sentence because you can never know everything in our industry. Kirsten, even as a trainer, is probably saying that on a date, when she's looking into real
There you
estate
go.
needs. So just feel confident saying, let me do some research and I get back to you, because they don't know that you in 10 years from now will know this off the top of your head. And that's
Right.
where your lender partners can help you support those questions.
Yeah.
And just be super outgoing and asking and having those conversations to bring up real estate. So the more you're talking to people, the more you're asking, have you thought about buying? The more successful, the more transactions. And that's really where you learn, is from doing the business.
Yep. Awesome. Well, thank you so much, Pam, and thanks everybody for coming today. And I will have this recording on our coaching platform probably either later today or sometime over the weekend. So if you want to review anything we saw today, you can hop right on there and we'll have it over there.
Thank you.
Awesome.
All right.
Thank you guys for having me.
Thank you.
Thank
Bye.
you.
Weekend, everybody. Bye.